In 2023 so far, we've actually seen a pretty good operating environment for Australian companies, and that's because we've seen very low unemployment, so demand for products has remained pretty strong domestically. In addition to that, we've actually seen good, robust demand for our exports into key markets, and a lower Australian dollar has helped with competitiveness there. So a pretty favourable backdrop. Unfortunately, as the year has transpired, we've seen more and more concern by market participants over the outlook. And really that's centred around higher interest rates, higher inflation, and then the spectre of geopolitical tensions weighing on markets as well. So pretty good operating environment, but certainly some dark clouds on the horizon. The key risks are really centred around those concerns that the market have, and principally that we see continued high inflation, high interest rates, ultimately leading to greater unemployment and therefore lower GDP domestically. And then we also have the threat that these geopolitical tensions escalate to the point where the global environment becomes much less stable. In addition to that though, we also have the risk of market participants exiting the market due to periods of uncertainty. And typically we've seen the strongest periods of capital growth for investors coming from market conditions that are emerging from this risk, negative risk appetite. And so we have a fine balance there between some real near-term risks around the economy, but also long-term risks for investors opting out of markets today. So actually the opportunity set is quite clear to us today, and that is we're looking for companies that are resilient to near-term negative economic sentiment and concerns, but still retain the ability to compound earnings and growth into the future. And so fortunately for us, it's exactly this type of business that negative market sentiment has led to being sold off. So I'll give you a couple of examples. One is CSL, Australia's own global provider of vaccines and medicines. Now this is a business that doesn't see a huge amount of volatility in demand for its products, yet the share price today is trading on its lowest level compared to the market that it has for 8 years. Another example, Transurban, they have a guaranteed right to collect toll revenue from networks of roads in our major cities for decades to come. Today that business is trading on more than a 5% yield, but with ongoing inflation and population growth, that yield will continue to grow in the decades to come. Now today, the share price of Transurban is lower than it was in the midst of COVID when all our cars were locked in their garages. So we see some real outstanding opportunities today in companies that have limited exposure to uncertainty around economies. These are businesses that both have high operating margins. So if we do see volatility in their cost base due to inflation or a little bit of uncertainty on their top line, they continue to make good profits. And importantly, these are both businesses that have multi-decade track records of delivering for shareholders, and we have high visibility in their ability to continue to do so for many years to come. The current market is throwing up some opportunities in some fantastic companies, notwithstanding some short-term investment market concerns. We think it's a really important time to think like potential business owners, not like traders of markets. And we see a really good long-run pathway for some of these fantastic businesses and particularly attractive entry points today.